Hey everybody, Smart Silver Stacker here. This is a one-year chart of the US dollar index, also known as the DXY or Dixie, as you may have heard it referred to. And as you can see from this chart, the value of the dollar, as measured by the Dixie, has moved up considerably over the past year. But the thing about the US dollar index is that it is only measuring the US dollar relative to other fiat currencies, because we know that compared to itself, the dollar has actually lost 8.6% of its purchasing power since last year, and that's according to the recently released CPI numbers. But around the world, a number of other currencies are coming under even more inflationary pressure. The euro, for example, has been getting hit hard by higher energy prices and higher prices for a number of goods, and a lot of that is related to the ongoing conflict between Russia and Ukraine and the sanctions that have been levied against Russia by the EU. Turkey is another example of a country dealing with much higher inflation. Goldman Sachs now saying that Turkey may experience up to 80% inflation by year end before any kind of relief comes. Now, the Turkish lira is not part of the basket of currencies that constitute the US dollar index that the dollar is measured against, but nonetheless, this illustrates nicely how countries around the world are under tremendous inflationary pressure that exceeds the inflation within the US. And it's not just Turkey and the euro. Also Japan, Japan has been held up as an example by advocates of modern monetary theory of how a country can go so tremendously deeply into debt and still have a functioning economy. In Japan, there is a very high national debt. The debt to GDP ratio is in excess of 200%. And now they are beginning to feel the effects of the decades of ultra loose monetary policy that they have had as inflation is beginning to rise and the yen is sliding in a very considerable way relative to the dollar. And yet they are doubling down and continuing with their ultra loose monetary policy. And here you are looking at the one-year chart of gold on the left and the one-year chart of silver on the right, priced in US dollars. And as you can see, gold, it's actually up year over year, but not by very much. And it's down considerably from the highs that it hit in March of about $2,050. Silver actually is down year over year. About a year ago, silver was around $27. Now it's at $21.68, so a pretty considerable decline in the price of silver there. Let's take a look at gold and silver priced in other currencies. So if we take a look at gold and silver priced in the euro, you can see that chart for gold actually looking a lot better than the one in US dollars. Silver still down year over year when priced in euros, but a lot less than in dollars. It was under 23 euros a year ago, and now at about 20.66. And gold is up considerably when priced in euros. Here are the charts in Japanese yen, and this gives you an idea of just how bad the inflation problem is getting in Japan. You can see that gold is up quite significantly year over year when priced in yen. Silver about flat, slightly down, but still that chart's looking a lot better than the one priced in US dollars. And then here's the charts for gold and silver in Chinese yuan. You can see gold up a lot more than it is in US dollars if you're pricing it in yuan. And then finally, here are the charts for gold and silver priced in Turkish lira. And clearly, if you're living in Turkey and you bought either precious metal, you are doing a lot better than anybody who was trying to save in fiat paper liras, who have seen a significant portion of their purchasing power evaporate. So while gold and silver may have some disappointing performance in US dollar terms, when you start looking at them in foreign currencies, you can see that they are doing their job of preserving purchasing power quite nicely. One of the reasons that the dollar is doing so much better than these other foreign currencies is because of the perception among investors worldwide that the dollar is a safe haven asset, that it is a store of value, and the belief also that the Fed is going to get the inflation under control in the US. And they have certainly been talking a good game about getting inflation under control. They're saying they're making it a top priority. They're going to pull out all the stops. We had the big 75 basis point increase in the federal funds rate recently. And, I don't believe that is going to get inflation under control. And let's talk about why. First, let's take a look at what Minneapolis Federal Reserve Bank President Neil Kashkari said just yesterday on Friday. He said that he supported the 75 basis point increase in the federal funds rate that we got at the recent FOMC meeting, And he said that a similar move might be appropriate in July, but after that, he thinks it's a good idea to resume the 50 basis point increases, as it's important not to raise rates too high as the Fed attempts to bring inflation down to its 2% target. So let's take a look at some historical data related to the CPI and the federal funds rate, and we'll see just how effective this Fed plan is likely to be. Now, here is the calendar for the FOMC meetings for 2022. This is right from the Federal Reserve website. And we just finished up this June meeting. Coming up soon, we'll have the July meeting, then another one in September, then one in November, and then one in December. So 4 more FOMC meetings for the remainder of the year. And let's say that the Fed, goes all out, and instead of doing a 175 basis point hike in July and then reverting to the 50 basis points, as Kashkari suggests, let's say that they just go all out and they go for 75 basis points at each one of these meetings. That would be quite hawkish according to mainstream perceptions. Well, that would put us at a federal funds rate of about 4.5% by the end of the year. So with that in mind, I'd like to take a look at this historical data presented by the Minneapolis Fed of the Consumer Price Index back all the way to 1913. And we don't need to go back that far. I want to take a look at a very specific period, the late 1970s and early 80s, because as the inflation numbers in the US have been moving up, this is something that we've been hearing a lot about. We've been hearing about how, this is the worst inflation since the 1980s. And if you look at the CPI back in 1979, you can see it's at 11.3%. And a lot of people might see that and think like, well, hey, the inflation's not as bad as it was back then because it's only at 8.6% right now. But the thing is, the CPI was calculated differently back then. That's a topic for another video, but suffice to say, inflation now is actually comparable or perhaps even worse than what we experienced in 1979 and 1980. Now, what did the Fed do about inflation back then? Well, here's a chart of the federal funds rate, and this is from the St. Louis Fed. And you can see that first, the thing I'll point out here is that the lowest the federal funds rate got on this time period from about 1975 to 1990 was right around 4.65. So that would have been, back in the 70s, considered extremely accommodative. And also, it's important to note that that low rate of about 4.6%, that is the kind of monetary policy that led to the high inflation that we saw at the end of the 70s and at the beginning of the 80s. So, think about how low interest rates have been here in the US, and that'll give you an idea of probably the kind of inflation that we are in store for. But also, it's important to note that starting in 1979, Fed Chairman Paul Volcker really began to crank up interest rates in an attempt to get inflation under control. And you can see that by August of 1979, the federal funds rate was already over 10%, and then they wound up cranking up the rate to 17.61% by 1980, and then the highest it got was in June of 1981, 19.1%. So clearly, the Fed had to really pull out all the stops to get the inflation of the late 70s under control. And if we take a look back at this table, you can see that it did bring inflation down, cranking rates up that high, although it took a while. I mean, they had 3 years of double-digit inflation, 79, 80, and 81. The CPI was double digits all 3 of those years, despite the big hikes up in interest rates. And then also, Neil Kashkari was talking about getting inflation back down to a 2% target. Well, that wasn't achieved until 1986, so it took over 5 years to bring inflation back down to 2%. And you got to remember that even though the inflation numbers dropped, all of this inflation is cumulative. So, in 1981 and 1982, prices were already way higher than they had been in 78 and 1979, and these inflation numbers just stack on top of that. So, even if the Fed is able to get inflation back down to 2%, the elevated prices that we're living with today are going to remain high. It's just the rate of change that is going to decline. Now, I don't think that the Fed is actually going to be able to get inflation back down to a 2% target with the type of hikes that we're seeing, because there's no historical precedent for it. Clearly, the federal funds rate had to be much, much higher than it is today in order to get this inflation under control that we saw back in the 1970s and 80s. And today, I just don't think it's going to be an option to crank up the rate of interest that high. I mean, for one thing, it would completely collapse the economy. Even back then in the 1979, 1980, when they cranked up rates, unemployment went up to about 11%. But the U.S. economy was in much, much better shape back then. And one of the things was just the level of debt. So if you take a look at the current level of debt, it's about $30 trillion. And if you multiply that by an interest rate of 19.1%, you can see that that would mean the federal government would have almost $6 trillion of debt service. To be specific, $5.73 trillion of annual debt service. So when you have the levels of debt that we have today, clearly a hike up to interest rates of near 20% is just completely unfeasible. And if you think about it, $30 trillion in debt, even if we get to that 4.5% level that I was talking about, that's like the most hawkish scenario for the Fed. That means that the debt service on the U.S. national debt is going to be $1.3 trillion. It'd be one of the biggest items in the federal budget. So, even those levels are probably not attainable. And, what does this tell us? It just tells us that the Fed is not going to be able to get inflation under control. And when investors realize that, the view of the dollar as a safe haven is going to change. It's going to begin to erode. And these charts, gold and silver priced in US dollars, is going to start to look a lot more like these charts of gold and silver priced in lira. So let me know what you think in the comments down below. Thank you all very much for watching. Don't forget to like, comment, and subscribe, and I'll catch you next time. Smart Silver Stacker, out.